What is up, Bitcoin Bulletin crew? Get ready to strap in, because the crypto universe is spinning faster than a satellite in orbit, and we've got the absolute need-to-know updates that will keep you ahead of the curve. This isn't just news, it's your essential intel dropped hot and fresh. Are you dialed in? Because the market waits for no one, and today, we're diving deep into a presale that's making serious waves, a major digital asset that's hitting a critical turning point, a financial giant's bold new take on a familiar digital currency, and a surprising shift in how a foundational crypto is being perceived. You do not want to miss a single second of this. Let's get this going. First up, we're tracking a presale that's not just showing up, it's challenging the established order for 2025, combining high growth potential with serious security measures that have analysts buzzing. Is this the next big thing or just another flash in the pan? We break it all down. Then, we're zeroing in on the flagship cryptocurrency itself. Despite a period of relative quiet on the charts, some critical indicators are flashing warnings. Is this calm before a storm, or just a temporary pause before the next big move? We've got the deep dive. Next, get this. A titan of traditional finance is weighing in, and their latest analysis suggests a major digital currency might be significantly undervalued compared to a very traditional store of value. We're talking about eye-opening price targets and a whole new perspective. And finally, we're looking at the quiet transformation of a cornerstone asset. It's shedding its wild reputation and evolving into something more stable, more institutional. What does this mean for your portfolio? Stick around to find out everything you need to know. Make sure you hit that subscribe button, ring the notification bell, and smash that like button so you never miss an update. Let's go. A presale poised to disrupt the 2025 landscape. The world of cryptocurrency presales is often a high-stakes arena, a place where immense potential meets significant risk. However, a new contender, MAGACOIN Finance, is emerging from this crowded field with a distinct strategy focused on combining high-growth prospects with robust risk mitigation. Positioned for the 2025 market, this presale is actively working to differentiate itself from established players like Bitcoin and Cardano, not just through its ambitious growth targets, but also through its commitment to security and transparency. While Bitcoin has long been recognized as a store of value, its growth trajectory, though impressive, is often viewed as more measured. Cardano, despite its strong technological underpinnings, has faced challenges in market momentum and decentralized finance adoption, which can limit its appeal for investors seeking more immediate returns. MAGACOIN Finance aims to carve out a niche by offering what many in the early-stage crypto space are desperately seeking: a blend of significant upside potential coupled with concrete security measures. What truly sets MAGACOIN Finance apart in the often opaque presale market are its proactive steps towards legitimacy and investor confidence. The project has undergone rigorous independent audits, notably by HashX, a firm renowned for its blockchain security expertise. These audits are crucial for verifying the integrity of the smart contracts and identifying any potential vulnerabilities that could be exploited. Furthermore, in a move that is still relatively rare within the presale ecosystem, the development team has completed Know Your Customer (KYC) verification. This commitment to transparency and accountability signals a serious intent to build trust with potential investors, setting it apart from projects that operate with anonymity. The project also emphasizes clear tokenomics, providing investors with a transparent breakdown of token allocation and distribution, alongside readily accessible public documentation. These foundational elements have not gone unnoticed by market analysts. Several observers have upgraded their outlook for MAGACOIN Finance, forecasting a potential 300x return on investment (ROI). This optimistic projection is largely attributed to the project's secure framework, its rapidly expanding community base, and its strategic positioning against more volatile meme coins and speculative ventures. The dual audits by HashX and CertiK have been particularly instrumental in bolstering investor confidence, providing a dual layer of security assurance. This focus on accountability and public information is crucial in a market segment often plagued by scams and rug pulls. positioning MAGACOIN Finance as a potentially safer alternative for investors navigating the complexities of presale investments. Comparisons have also been drawn to other prominent cryptocurrencies, such as Solana and Dogecoin. While Solana has shown impressive performance in blockchain revenue and institutional interest, it has also experienced significant price volatility. Dogecoin, a beloved meme coin, maintains strong community backing and liquidity, but lacks the structured development and security protocols of MAGACOIN Finance. The project is thus being presented as a unique hybrid, offering a structured pathway for investors seeking an asymmetric risk-reward profile, balancing the allure of high growth with the assurance of built-in safeguards. But is this security enough to truly challenge the giants? Stay tuned as we uncover the underlying currents shaping the future of a major digital asset. Bitcoin's quiet stability, a bearish undercurrent. In early September, Bitcoin experienced a dip below the significant $108,000 mark, a move that has injected a fresh wave of uncertainty and bearish sentiment into the cryptocurrency market. This price action has come after a period of notable consolidation, where the flagship digital asset had maintained a semblance of stability. However, this calm on the surface is now being scrutinized by analysts who believe it might be masking a more precarious situation, potentially leading to a bearish crossroads. The reduced volatility observed in Bitcoin's recent trading history is a key point of discussion. Many interpret this as a sign of the asset's maturation, solidifying its role as a long-term store of value rather than purely a speculative instrument. This evolving identity suggests a growing confidence from investors who are looking for assets that can preserve wealth over extended periods, akin to traditional safe haven assets. The market capitalization growth of Bitcoin has, in many ways, mirrored this trend of decreasing price swings, indicating a more stable and perhaps more mature market. However, this period of reduced volatility is not universally seen as a bullish indicator. Market analyst Luca has pointed to a divergence between Bitcoin's open interest and its funding rates as a critical signal of underlying bearish pressure. While open interest has seen an increase, suggesting more participants are entering the market, the funding rates have been trending downwards. This combination is often interpreted as a sign that short sellers are gaining dominance, betting on a future price decline. This bearish positioning is particularly concerning as the market heads into September, a month historically associated with weaker performance for cryptocurrencies. The current market structure, therefore, appears to favor bears, with indicators suggesting that the consolidation phase could be on the verge of breaking down. Furthermore, Bitcoin's recent performance has lagged behind traditional markets, specifically the S&P 500. While Bitcoin has seen modest gains, the S&P 500 has experienced a much more robust rally, largely propelled by the surge in AI-driven equities. This underperformance highlights the challenge that cryptocurrencies face in matching the growth momentum seen in traditional asset classes, especially those benefiting from immediate technological and economic tailwinds. Dawn Crypto Trades noted this disparity, observing that Bitcoin has been consolidating for months with minimal movement compared to the significant upward trend in the S&P 500. This comparison underscores a key narrative. While Bitcoin may be maturing as a store of value, it is currently struggling to compete with the rapid growth seen in other sectors of the financial world. Analysts are now keenly observing whether Bitcoin can break free from its current consolidation. A decisive and sustained move below the $108,000 level could indeed trigger a more significant correction, potentially unwinding some of the gains made earlier in the year. Conversely, a successful retest of key resistance levels might provide more clarity on the market's ultimate direction. For the time being, however, the prevailing sentiment among many market watchers is one of caution, with the balance of power leaning towards the bears. The combination of bearish market structure, unfavorable funding rates, and underperformance relative to traditional markets paints a picture of potential downside risk. But what if this quiet transformation is actually a sign of strength? We're about to explore a major financial institution's surprising take on Bitcoin's true value. JPMorgan's bold claim, Bitcoin undervalued against gold. In a striking assessment that challenges conventional market perceptions, JPMorgan has declared that Bitcoin is significantly undervalued when stacked against gold. This bold assertion is rooted in a detailed analysis of Bitcoin's declining volatility, a factor that has historically been a major point of contention for institutional adoption. The financial giant's research indicates that Bitcoin's 6-month volatility has plummeted from a high of nearly 60% at the beginning of 2025 to around 30%, reaching its lowest recorded level. Crucially, the volatility ratio between Bitcoin and gold has narrowed to a mere 2. This means Bitcoin is now only twice as volatile as gold, a stark contrast to historical data where the ratio was considerably wider. This convergence in volatility profiles suggests that Bitcoin is increasingly aligning with gold's characteristics as a more stable, albeit still more volatile, asset class, making it a more palatable option for traditional portfolios. Based on this volatility-adjusted framework, JPMorgan's analysts estimate that Bitcoin's market capitalization would need to increase by approximately 13% to reach parity with the private investment currently held in gold, which stands at a staggering $5 trillion. This calculation translates to an implied price target of roughly $126,000 per Bitcoin. Given Bitcoin's current trading range, this suggests an undervaluation of around $16,000. This valuation gap implies that as Bitcoin continues to shed its high volatility reputation, there is substantial room for price appreciation, particularly as institutional investors are likely to find it more attractive to allocate capital to an asset with a reduced risk profile compared to its earlier, more volatile days. A primary driver behind this significant reduction in Bitcoin's volatility, according to JPMorgan, is the increasing trend of corporate treasuries accumulating the digital asset. These entities now collectively hold over 6% of Bitcoin's total supply. The report draws a parallel between this accumulation and the effects of quantitative easing by central banks, where asset hoarding on balance sheets tends to reduce market volatility. Furthermore, the increasing inclusion of Bitcoin-related assets in major equity indices is playing a crucial role. This trend attracts passive investment inflows, further contributing to price stability. For instance, companies with significant Bitcoin holdings have seen their market status upgraded, leading to their inclusion in global benchmarks, which in turn amplifies institutional interest in Bitcoin-linked investments. The analysis, spearheaded by JPMorgan strategists including Nikolaos Panagurtsoglou, attributes this compression in volatility to a confluence of factors. These include the growing stability provided by corporate treasury holdings and broader structural market shifts, such as enhanced index inclusion. Together, these elements contribute to smoother daily price movements and a diminished overall risk perception for Bitcoin. The firm's volatility-adjusted valuation model strongly suggests that the current market price of Bitcoin does not fully account for its diminished risk profile when compared to gold. Consequently, the asset might be trading at a discount relative to its fair value on a risk-adjusted basis. This perspective from a major financial institution carries significant weight. Industry commentators are actively discussing the implications, with some suggesting that Bitcoin could eventually achieve parity with gold in terms of overall market value. While JPMorgan has not set such a long-term target, their analysis clearly indicates that the conditions are ripening for Bitcoin to command a higher valuation as it matures as a recognized asset class. The report emphasizes that the structural developments and reduced risk are laying the groundwork for Bitcoin to justify a higher price relative to gold, even if the timeline remains uncertain. But is this perceived stability the whole story? We're now turning our attention to how this foundational crypto is fundamentally changing its identity. Bitcoin's evolution from volatile ride to stable asset. JPMorgan has put forth a compelling argument that Bitcoin is currently undervalued relative to gold, primarily due to a significant reduction in its volatility. The firm's research highlights that Bitcoin's 6-month volatility has decreased dramatically, falling from nearly 60% at the start of 2025 to approximately 30%. This marks a historic low for the digital asset. Consequently, the volatility ratio between Bitcoin and gold has narrowed to 2, indicating that Bitcoin is now only twice as volatile as gold, a considerable shift from previous periods where the discrepancy was much larger. This narrowing gap is making Bitcoin increasingly attractive for institutional investors who often evaluate assets on a risk-adjusted basis, bringing it closer to the characteristics of gold as a perceived store of value. Based on this recalibrated volatility metric, JPMorgan's analysis suggests that Bitcoin's market capitalization would need to increase by about 13% to match the $5 trillion in private investment held in gold. This implies a price target of roughly $126,000 per Bitcoin, indicating a potential undervaluation of approximately $16,000. This perspective suggests that as Bitcoin's risk profile continues to mature and its volatility compresses further, there is substantial potential for upward price movement, particularly as institutional adoption grows and finds the asset more palatable for inclusion in diversified portfolios. Several key factors are contributing to this observed reduction in Bitcoin's volatility. A significant driver, identified by JPMorgan, is the growing trend of corporate treasuries accumulating Bitcoin. These entities now hold more than 6% of the total Bitcoin supply, a move likened by analysts to central bank quantitative easing, which historically stabilizes markets by locking assets into long-term holdings. Additionally, the increasing inclusion of Bitcoin exposure within equity indices is playing a crucial role. This facilitates passive inflows from investors who gain exposure to Bitcoin through broader market funds, thereby contributing to price stability and reducing sharp daily price swings. Companies that have substantial Bitcoin holdings are being recognized and added to global benchmarks, further enhancing institutional interest and demand for Bitcoin-related assets. Analysts at JPMorgan, including Nikolaos Panagurtsoglou, attribute this volatility compression to a combination of a more stable holder base and significant structural market developments. The growing presence of corporate treasuries and the expanding inclusion in equity indices are seen as key elements that temper daily price fluctuations and lower the perceived risk associated with Bitcoin investments. This evolving risk profile means that Bitcoin may now justify a higher valuation when compared to gold on a risk-adjusted basis, a notion that the firm's quantitative models support. The current undervaluation, therefore, is seen as a consequence of the market not yet fully pricing in these structural changes and the reduced risk associated with the asset. The implications of JPMorgan's findings are far-reaching, prompting discussions about Bitcoin's potential to eventually rival gold in terms of market capitalization. While JPMorgan's immediate projection focuses on a $126,000 price target based on volatility parity, the underlying analysis suggests a more profound shift in Bitcoin's status as a maturing asset class. The conditions are increasingly favorable for Bitcoin to command a higher valuation as its integration into traditional finance deepens and its risk profile continues to stabilize. The report emphasizes that the combination of reduced risk and ongoing structural market developments provides a strong case for investors seeking long-term exposure to a digital asset with growing institutional backing and a more predictable risk-reward profile. So, where does all this leave us? Get ready for a rapid-fire recap of today's biggest stories. And that's a wrap on another action-packed Bitcoin bulletin. We saw a presale making bold moves with security at its forefront, Bitcoin navigating a potentially bearish crossroads despite its calm, a major bank calling Bitcoin undervalued against gold with a $126,000 target, and Bitcoin itself transforming into a more stable, institutional asset. Don't miss out on any of these critical updates. Hit that subscribe button, ring the notification bell so you're always in the know, and give this video a thumbs up if you found it valuable. Share your thoughts in the comments below, and make sure to follow us on all social media platforms for real-time insights. We'll see you in the next one.